In this lecture, we continue our discussion of capital budgeting decisions. What are we talking about? So capital budgeting is the process when we evaluate specific investment decisions. And this term particularly refers to the operating assets. So it's not about financial assets anymore. We are not talking about bonds. We are not talking about stocks. We are talking about operating assets used in production. Machinery, technologies, production lines, manufacturing, something like this. Why we are talking about this? Because investment projects are the main sources of shareholders' wealth. So any firm uses real assets in order to earn cash flows. And those cash flows are the sources of the shareholders' income and, in general, shareholders' wealth. So that is why we need to analyze this side of the corporate finance very carefully. What do we know till this moment? At least what we are supposed to know till this moment. We are supposed to know how 5 of 6 methods work. So there are 6 key methods, and we are supposed to know 5 of them. Payback, discounted payback, net present value, or NPV in short, internal rate of return. So this is what you must familiar with till this moment. And this is what you must be able to compute given cash flows. We still don't know what is modified internal rate of return, MIR. That's what we are planning to study today. And profitability index, very simple. If you know how to compute net present value, profitability index is not difficult. So we continue discussing the particular features of these methods today. First of all, we will discuss an important thing, how net present value and internal rate of return interact with each other while making decisions about investment projects. In many cases, these two methods, these two criteria produce similar signals. We know that net present value measures money. This is an increase in shareholders' wealth because of the investment project realization. How wealthier is shareholder after this investment project is started. Internal rate of return measures profitability in percent. Some people prefer to measure money and make decisions when looking at the monetary indicators. Some people prefer interest rates. Like, I want to invest my money into something with profitability 25%, and I prefer this over something with profitability 20%. So we need to understand the specifics of both methods in order to prevent the situation when these two criteria give us contradictory signals. When NPV says choose project A and internal rate of return says choose project B. So through this lecture, we will use the following example projects. So the same examples as we used in the previous lecture. So we have years and we have the following cash flows. Both projects S and L require 1,000 of something like 1,000 million, like 1 billion rubles, for example, or yuans, whatever, dollars, euro, of investments before the project starts. And then we expect 500, 400, 300, 100. Again, million rubles, million yuans, million euros, million dollars, whatever. Project L has another scheme, so we see that we start with relatively small cash flows, and then through the course of this project, cash flows increase. And the cost of capital for this project is going to be 12%, as in the previous lecture. So we start with the object which is called NPV Profile. What is that? This is a graph that shows a project's net present value against different cost of capital. If you want to construct this NPV profile, we need to calculate net present value at different costs of capital and plot these values. And internal rate of return is going to be at the discount rate where net present value equals 0. So graphically, it's going to be the point where net present value profile crosses the horizontal axis. Given that you know the mathematical nature of internal rate of return, you should be able to find it graphically. So for those projects that we have seen on the previous slide, net present values, if the cost of capital is 0, are going to be these. Cost of capital 5%, net present values are going to be these. So project L is better than project S because project L gives us larger increase in shareholder wealth. When cost of capital is 10%, the situation is opposite. Now, under 10% cost of capital, project S is more attractive for shareholders because it increases shareholders' wealth better than project L. Finally, if the cost of capital is 15%, neither of these projects is acceptable because both projects have negative net present value. So how to compute these numbers? We know from the previous exercise session. At least we managed to calculate net present value for two projects. The same is applied here. We are changing the interest rate or discount rate. Now here is a graph of this net present value profile. This kind of orange line, I don't know, dark yellow line, shows project L net present value profile. So what do we see? Let's go back. When cost of capital is 0, NPV is 400. When cost of capital is 5, NPV is 206. When cost of capital is 15, NPV is minus 80. So that's precisely these 4 points that we are able to see along the dark yellow line. Cost of capital 0, NPV 400. Cost of capital 5, NPV is almost 200. Cost of capital 10, NPV is something like 70, right? No, 49 here. Sorry, here, 49. And when cost of capital is 15, NPV is minus 80 here. What is graphically internal rate of return? So graphically, it is the point, the interest rate, where our dark yellow line crosses the x-axis, horizontal axis, is here. We computed it in the previous lecture, and it was 11.8%. So just to prove that I am not lying you here, when we spoke about internal rate of return, we computed this number, 11.8, exactly, precisely for this project. Here. This, I don't know, blue or green or greenish line is probably that's emerald, whatever. This line shows us the NPV profile for project S. It starts with 300 here, then it goes to 180 under cost of capital 5%, then it goes to almost 100 under cost of capital 10%, and then it's here minus 8, 33, and cost of capital is 15. Internal rate of return is 14.5. Again, no trick here. We computed internal rate of return of this project. And this is the point where NPV profile crosses the horizontal axis. There is one more point, which is called here crossover rate here. So you see that at this point is 7.2, and at this point both lines intersect. So what is special about this crossover rate? Net present value of project S equals to net present value of project L when cost of capital is 7.2. Basically, we are not able to choose with the help of net present value which project is better, S or L, if cost of capital is 7.2. Now, what else do we see from the plot? The plot shows that NPV profiles decline as the cost of capital increases, which is no surprise for people who know something in mathematics. If you look at the way how net present value is computed, we immediately see that net present value and interest rate or cost of capital here are connected in the opposite way, or in a negative way, has negative correlation, let's say. When R increases, the whole denominator rises and the fraction goes down. So the whole sum goes down as well. So therefore, we see that with the increase of cost of capital, NPV profile declines. We also see that when cost of capital is low, 5%, maybe 4 or 3, project L is more preferable because it has larger net present value. But after crossover rate, project L becomes less preferable and project S becomes better. Yeah, project S has the higher NPV if the cost of capital is greater than 7.2%. Yes, we already discussed that 7.2% is called the crossover rate. What else do we see? We see that project L is more sensitive to changes in the cost of capital. So how this sensitivity is measured? With the slope of this line. If this line goes down faster, then net present value is more sensitive to changes in cost of capital. So look, if cost of capital changes from 5 to 10, NPV for project L drops from almost 200 to almost 50 here, which is something like 150. For the same change in the cost of capital from 5 to 10, project X loses net present value from, how much is that? Something like 180, right? To 80. So this change is minus 100. For project S is less sensitive. We already saw this effect when we spoke about bonds. The longer term bonds, the bonds with larger duration, are more interest rate sensitive. Same thing with projects. Exactly the same mechanics applies. So if a project has most of its cash flows coming in the early years, its net present value will not decline very much if the cost of capital increases. So basically, if you're able to get your money back sooner, faster, net present value of your project is not going to be that sensitive to the interest rate change. Now we need to introduce two concepts. How projects, different projects, can be compared to each other. One situation is when you compare independent projects. So what are the independent projects? Those are projects whose cash flows do not affect one another. So for example, if you are thinking about opening 3 different shops at 3 different cities, those can be considered as independent because neither of them would influence the other. If you accept or reject one project, it does not influence the decision about the others. That's why we are calling them independent. In the case of independent projects, NPV and IRR, net present value internal rate of return, always lead to the same accept or reject decision. That's crucial. So if NPV says accept, IRR also says accept. At any cost of capital less than internal rate of return, project will be acceptable by both NPV and IRR. Look, if we are not comparing these two projects, if we are simply looking at one project and the other project independently, at an interest rate of 10%, both projects have positive net present value. These and these, they both are acceptable. And for them, for both of them, internal rate of return is above the cost of capital, which means that both projects are acceptable if they are independent. That's what I said. At the cost of capital 10%, NPVs is 78.82 is greater than 0 and IRRs is 14.5, which is also greater than 10%. So project can be accepted. Both criteria signal about the same decision. At the cost of capital 10%, project L has positive net present value and also has internal rate of return, which is greater than the cost of capital. So we also can accept this project. No contradiction, no problem, same decision. Now, Another case is when projects are mutually exclusive. What are mutually exclusive projects? Those are projects when one project is taken, the other must be rejected. So decision about one project affects the decision about the other. For example, if you are thinking about expanding existing plant or demolishing and building the new one, these are two mutually exclusive options. You are not able to do both. You either renovate the existing plant or you completely destroy existing plant and build a new one on the same spot. You cannot do both. You cannot build a new plant and renovate the old plant on the same construction spot. It's not possible logically, physically, naturally, not possible. So these two projects are mutually exclusive. In this case, you need to choose one better, best project. So now assume that our projects, project X and project L, are mutually exclusive. We can choose only one, or we can reject both, but we are not able to accept both. It's forbidden, logical. Then the situation becomes interesting, because if the cost of capital is greater than 7.2%, then NPVS is greater than NPVL, IRRS is greater than IRRL. So let's go here. So if cost of capital is, for example, 10%, NPVS is greater, it's 80 something. IRRS is greater, it's 14.5 versus 11.8. So both criteria signal about the same decision. Project S is better, choose project S. Project L should be rejected because we cannot accept both. But suppose that the cost of capital is less than the crossover rate. In this case, net present value of L is gonna exceed net present value of project S, but IRRs are related in the same way. If you look at the NPV profiles graph, you will immediately see that IRR are not changing with the cost of capital. They are always there. They always cross x-axis at the same place, while net present value changes depending on the cost of capital. And it is possible to get into this situation. When cost of capital is 5%, project L is better in terms of NPV, but project S is better in terms of IRR. Now we have a question. Which one to choose? So there is a conflict. There is a conflict between two criteria. One criteria says choose L, another criterion says choose S. Which one to choose? Logically, NPV method is better. Why? It selects the project that adds the most to shareholders' wealth. And this is why we always prefer net present value over internal rate of return. Usually we look at the NPV. But this question still exists. We need to understand why. this conflict arises. What is wrong with NPV or what is wrong with IRR? That they contradict each other. Well, there are two basic conditions that can lead to the conflict between NPV and IRR. So first condition is difference in the project sizes. One project is large, another project is small. You have different investments, and it is natural to think that large project must have large NPV, but probably it will have lower profitability in terms of internal rate of return. And they would lead to the contradiction. Another case that we see here in two projects, Project S and Project L, is difference in the project timing. In Project S, we get the most earlier. In the Project L, we get the most later. That's why we have this contradiction. Is this good? How useful is it to generate cash flow sooner rather than later? So basically, the question is, do we really want to earn money earlier? What should we do with them? We are not talking about consuming money. We are not talking about consumers. We are talking about investments. Investments. In investments, money must work. What does it mean? It means that we do not care about earning money as soon as possible. We are not going to spend them. We are concerned with profits. And if I receive money earlier, I need to take care to reinvest them. So, and the value of these early cash flows depends on the return we can earn on those cash flows. So the rate at which we can reinvest these cash flows. Mathematically, NPV assumes that reinvestment rate is the cost of capital. So you earn money, and instead of eating it, consuming it, you invest this amount somewhere else. What is the return on your investment? It's gonna be cost of capital, which is reasonable. So we'll talk about cost of capital later in one of the lectures. For now, you can think about the cost of capital as the alternative return that the company can use, the company can receive. In the internal rate of return method, we assume that the firm reinvests at this same interest rate, at the IRR, which does not exist in reality. You do not have any opportunity to invest at this interest rate. And this is a problem. And this is the weakness of internal rate of return method. So the better assumption that the project's cash flows can be reinvested at the cost of capital, which means that NPV is more reliable. So in short, if you have a contradiction between NPV and IRR, choose NPV. There is another problem with internal rate of return, which is called multiple IRRs. What's that? Sometimes we are not able to use internal rate of return when project has something which is called non-normal cash flows. What are those non-normal cash flows? What's that? So a project has normal cash flows if it has one or more cash outflows followed by a series of cash inflows. So here I'm showing you only signs or direction of the cash flow. So you have outflow and then you have inflows. This is exactly an example of our project S and project L. So both project S and project L have outflow in the beginning and then four inflows afterwards. Or you may have something like this. You may have 1, 2 outflows and then inflows. These are normal cash flows. Non-normal cash flows occur when there is more than one change in sign. For example, investment, inflow, then again outflow, 2 inflows. You see that the sign changes 2 times. Here 1, here 2. Or you have investment, then you have some inflows, and then investment again in the end. So this is not a specific thing, this one. This may happen when you need to invest a lot in order to close your project. You probably need to clean the construction spot after yourself. You probably need to do some environmental protection actions after your project. You probably need to utilize some chemicals, something like that. So many projects have this negative outflow, negative cash flow outflow in the end. So don't think that this is something special. And this is completely technical, formal, mathematical question that if a project has non-normal cash flows, it can have multiple internal rates of return. Why? We know that internal rate of return mathematically defined as a solution to this equation. What this equation looks like? This is a polynomial of degree n. All of us know this from the school. The polynomial of degree n. A plus bx plus cx squared plus dx cubed plus ex to the power of 4 and so on equals 0. What do you know also from the school? We know that the numbers of root, non-imaginary roots, for those polynomials, let's say maximum number of non-imaginary roots for the polynomial of degree n equals to the number of switches from plus to minus or from minus to plus. All of us studied this in the school. Therefore, it has some application to our financial management task. If you have only one switch like this or this, there is gonna be at most one non-imaginary root, which is internal rate of return. And that's okay for us. But if you have 1, 2 switches, or 1, 2 switches here, or maybe 3, 4, whatever. At most, we have 2 or 3 or 4 roots for this polynomial. It doesn't mean that it is necessarily gonna be 2. No. It's not necessary condition. But at most, 2 are possible. And let's consider an example. So initial outflow is minus 1.6 million rubles, let's say. Cash flow in the first year is 10, so we have some return. And then again, outflow in the second year, minus 10. So internal rate of return is the solution to this polynomial. Minus 1.6 plus 10 over 1 plus IRR power of 1 minus 10 1 over 1 plus IRR to the power of 2 equals 0. So we see that we are, so the signs are switching 2 times. One here, second here. And this equation has 2 roots, 25% and 400%. Now the question is, what is the profitability of this project? And we have 2 profitabilities. One profitability is 25%, another profitability is 400%. But, well, formally you don't have any way how to discriminate which profitability is the correct one, which one is not. No, you have 2 profitabilities, you need to live with this. Yeah, so the IRR is both 25 and 400%. We are not able to identify internal rate of return. So this is the graph. This is the NPV profile for this particular project, and we see that NPV starts far away in the negative area. Then it crosses horizontal axis once at 25%, and then NPV becomes positive only here when cost of capital exceeds 25%. NPV becomes positive. And then it reaches its top somewhere around 100, or maybe 100 something, right? Not sure. Yeah, maybe 120, something like that. And then it starts to decline until 400. So no problem arises if NPV is used. We just take cost of capital, compute NPV, and we know that for any cost of capital between 25 and 400, NPV is going to be positive, and we are going to accept this project. But as for, so yeah, if cost of capital, for example, 10%, NPV is negative, the project is rejected. If the cost of capital is 100% and NPV is positive, and the project is accepted. It's very simple. But we have multiple internal rates of return, and we are in trouble. We are not able to interpret the situation. And finally, we are coming to the improvement of internal rate of return. So why? You can ask, why do we care about internal rate of return if it is so bad, and if NPV is usually better than internal rate of return? The problem is, no, not a problem, maybe. The reality, let's say, reality is that many executives prefer internal rate of return over NPV. I have seen in my professional life many people who really wanted to know what is the return on their investment. They don't care about monetary terms. They are reasonable. I mean, so it's also a good question. Instead of asking how much I'm going to earn in rubles, dollars, euro, yuans. They ask what is going to be returned on my investment. Given the problem is internal rate of return, it is very dangerous to rely on interest rates. So we need to do with this something. And we improve IRR with the measure called modified internal rate of return. So the formula is much simpler than it looks like. I guess you're looking at this formula and, oh my god, there are so many elements there. There are sums, there are some COF, whatever. So something strange is happening. We are managers, we don't want to do mathematics. It's very simple. COF, cash outflows, everything with negative numbers. Everything that we have as negative numbers, we take to the left-hand side of this expression. And compute present value. CIF are cash inflows, positive numbers. So everything with positive number goes to the right-hand side. And this is the future value. If you remember something from the beginning of our course, lecture must be 3, I suppose. Yeah, it's here. Look, here is the formula of a future value. Cash flow multiplied by 1 plus r to the power of n minus t. Now compare. This is exactly future value of positive cash flows. This is present value of negative cash flows. This is a number we are able to compute. This is another number that we are able to compute. Now, they are linked with this 1 plus mir to the power of n. So this is the unknown. This is what we want to compute. So as I said, the left term is the present value of investment outlays. And the numerator of the right term, this one, is the future value of the inflows. Let's see an example how to compute this modified internal rate of return. So we do this in steps. First step is to compute left-hand side. The left-hand side is formally this. We have only one negative cash flow, which is 1000 in the beginning, and we divide this by 112 to the power of 0, which is 1000. The numerator of the right-hand side is this. I'm taking 500 times 112 to the power of 3. 400 times 112 to the power of 2. So what is going on here? It is reinvestment. We assume, we imagine that we earn these amounts and we are investing them at the cost of capital, interest. 300 times 112 plus 100. And this is the result. So maybe this step is the most difficult step. And now the last step. We have 1000 equals to 1,500, 79.50 divided by 1 plus mir to the power of 4. So we need to express mir and compute it. So we express it. This divided by 1000 to the power of 1 over 4 minus 1, and this is 12.1%. That's all. We have computed a robust measure of a percentage return. It's not internal rate of return anymore. It is modified internal rate of return, and it has all strength of the initial measurement, but we have tried to get rid of all the drawbacks of internal rate of return. And in order to, so this is the scheme, how do we compute it? So negative cash flows go back in time to the present value, to the present time. All positive inflows go further forward to the future. And then we kind of connect them through the modified internal rate of return. This. In order to show that this measure is robust, we compute MIR for a project with multiple internal rates of return that we have seen recently. So, this is a reminder, what kind of cash flows do we have? Now, on the left-hand side, we take two negative cash flows, this one, this one, and we compute their present value here. Of course, we drop minuses because we are talking about cash inflows here. This is the right-hand side. 1.6 divided by 1.1 to the power of 0 plus 10 over 1.1 to the power of 2. So be careful, we are talking about this 10, not this 10. On the right-hand side, we are taking positive cash flows, which are only this, which is only this, and compute its future value, like this. And then we, again, connect both future value, present value, with the help of MIR here. And modified internal rate of return for this project is going to be 5.6%. And look, there is no contradiction anymore. Modified internal rate of return is less than cost of capital, so we do not accept this project, or we reject this project. Again, because interest rate is always compared with the cost of capital. So this is all that we can say about additional things in capital budgeting. So now we know all the 6 methods of investment project evaluation. So we today have covered MIR. We also know that whenever possible, whenever there is some contradiction, we use NPV, because NPV is more reliable. But if you really need a relative profitability measure, so you can opt for modified internal rate of return, because it does not have the problems of IRR. So that's all for this topic.